the analyst who made the call, Michael Morris, entertainment and media analyst at Guggenheim Securities. So you still think it's a buy, Michael, and your price target is higher, but it's a little bit of a different economic model for Netflix going forward. Explain.
Yeah, absolutely. I would separate the two things here. The price target change really is not unique to Netflix. It's indicative of a fresh look, I think, across the industry that not just us as analysts, but the entire investment community has to take with the prospect of higher interest rates and a greater focus on near-term profitability as a core valuation metric. But I want to make sure that we stay focused on what I do think is a very promising and economically expansive opportunity for the company, and that is rolling out an ad-supported tier. The company already referenced that on their most recent earnings call, but we put some more specificity around when we think it will happen and how much of a contribution we think it can make to the company. And we think it's one of the most exciting things in the media and streaming business that's going to happen over the next 6 to 12 months.
Stock is down 70% from the highs. So do you think that Wall Street just doesn't appreciate the opportunity that is the ad-supported funding? Because from my perspective, you mentioned the higher interest rates. Yes, they're getting a valuation reset, but the fundamentals have been weak as well with the subscriber loss.
Absolutely. I think that, keep in mind what we're trying to do is make good decisions going forward and not necessarily dwell on the mistakes that have been made, but learn from them. In the case of the stock coming down, I think a big part of that is a realization that the market had about the limitations of the long-term growth for the premium or the subscription-only tier for the business. If you look back 2 years, say pre-pandemic, there was a view that there were 800 million global broadband households that really represented an addressable market for this business. There was not a lot of competition. It looked like there was a tremendous amount of runway. And then even entering the pandemic, there was a lot of mixed signals with respect to how much demand was pulled forward, how much was true underlying demand. Over the course of the last 2 to 3 quarters, what we've seen is really strong indications of maturity of the business in the context of its premium tier. Some of that can be competition. Some of that can be streaming fatigue. There are a number of reasons, but the bottom line is the move from the ultimate highs of the stock to where we were previously really had to do with the market digesting the maturity. The change that we made today in our valuation has to do more with the interest rate environment and our valuation parameters, but we still see about 30% upside for the shares from here.